Gary, can you tell myself and the audience a little bit about the 24 Dynamic Bond Fund that you run, please?
Yes, certainly. The fund's now been running about just about 6 years. We set it up primarily in the strategic bond sector. We wanted a bond fund that was going to be truly dynamic, and first and foremost it was going to be an income generating fund that was there to protect capital. First and foremost, that's what it's about. But being strategic, it had to be an income generating fund throughout the whole of the credit cycle and economic cycle. So when we set that fund up, it was all about, with one eye on the liquidity, to move the portfolio, the components of the portfolio, to suit the underlying environment. And I believe that the performance over the last 6 years, I think that the way that the architecture was set up, it's been justified because the performance has been exactly that. We've generated income throughout the what has been a fairly problematic last 5 years, and who knows what's going to happen over the coming few years. But we think that we have the skill sets, we certainly have the products available to us in the fixed income world to continue that income generation over the complete cycle.
And how's the fund positioned at the moment?
We have a couple of what we would say core sectors that we absolutely firmly have a very high conviction over, and we recognise the relative value. One is the ABS sector in Europe, European, I hasten to add.
That's asset-backed securities.
This is asset-backed securities. These are secured assets. We only look at the European here. We're not talking about US mortgage deals that I know that a lot of people are concerned about, quite rightly so. The European ones have a different legal setup compared to the US. So we like those. We recognise that they represent very, very good, compelling investments. They lend themselves perfectly for quantitative analysis, which is always good coming from a credit standpoint. We like to be able to stress test them. They also represent very, very good relative value on a spread basis, where your typical mezzanine tranche, which is the middle tranches of the asset-backed securities, something like a double B in the European CLO market, which are backed by European loans. Those we can typically get very, very good, sound, very, very good structures there that are double B rated, around 6.5 to 7.5%. Compare that to the European single name double Bs, where you're getting probably 3 to 4%. So you are getting a good pickup if you're prepared to do the due diligence and the analytical work to get comfortable with the ABS. So we do recognise that represents good value. We like that sector, and that's likely to continue going into 2017. We also have a very good understanding of financials at 24. There were 4 of us on the partnership that actually were managing directors of large international banks. I myself have been through Basel 1, Basel 2, 2.5, Basel 3, CRD4, and soon to be Basel 4 as well. So I've watched and lived through that regulation. I think we have a very good understanding of the regulatory changes that banks have undergone recently. They have got stronger balance sheets. They are more transparent. Once again, banks are quite complicated structures to actually to analyse, but if you do the work, there are some compelling investment opportunities to be had there. So we do like the subordinated financial sector. We've also liked European high yield because of the impact of the European Central Bank, the intervention in the markets through their asset purchase program over the course of the last 9 months. That's obviously going to continue until the end of March at least. We wouldn't be surprised to see there be an extension of that program for at least another 6 months. However, and this is a big however, Mr. Draghi, who is head of the ECB, at some point in time will have to mention the word tapering. Sooner or later, the ECB are going to have to take their foot off the gas. Now, he's already done an awful lot. He's broken the back of the fixing the transmission mechanism in Europe. There's still some way to go. I think it gets extended, but the minute that he actually reduces those monthly purchase amounts from 80, might be down to 60 at some point in time, still be buying it, but the minute he starts to mention the word tapering, the market is likely to take that in a bad vein of light. Remember what happened when Bernanke first mentioned tapering back in the US in 2013. The markets went through a period of quite a degree of stress and volatility. Draghi would have learned from that, so therefore he will have to be at his most eloquent best in order to avoid the same to happen here in Europe. We just don't want to be that long in European high yield when that happens. We would rather look at something like the US market, where they've been through their first hikes and they are going through this degree of transfer. They're in the middle of their transition period. So we may well be shifting some of our European high yield to some of the US high yield. Once again, still on a high conviction relative value basis, but just moving the general sort of beta of the fund from Europe to the US in that high yield sector. So there will be some subtle changes. For us, gilts are still not the right risk-off trade. We do expect some volatility, but gilts are not the place to actually to run to as a safety haven. They are still acting more like a credit than a risk-off because of the uncertainty surrounding Brexit and Article 50, etc. So for us, the long end of the Treasury curve is the natural safety haven, despite the fact that the FOMC may be raising in December. But the long end is probably better protected than the short end. One thing I would always say, remember, with the volatility, if you're holding a dated bond, the coupon and the port to par will always trump short-term volatility. So it's just a question of sitting with it, riding through. Ultimately, so long as you avoid default, bonds are the place to be.
Thank you. If you enjoyed the interview, please subscribe to our YouTube channel below.